In this video we'll be looking at budgets, including the usefulness of the process of budgeting to a business and also how they might carry out something called variance analysis. A budget is an estimate or target for financial data over a period of time. So this could be for income, so you can have a budget for your sales revenue that's going to be coming into your business. It could be for expenditure, so a cost-based budget for how much you're going to be spending, or it could be a profit budget, which would be the difference between the two. You take your expenditure budget away from your income budget. And this process of budgeting is going to be really useful for a business for a few reasons. It's going to help them to control and monitor their expenditure, particularly across different departments. So it helps them to set targets and keep track of how much each of their different departments are spending, which is going to be important for making sure that each department is being efficient with their use of money, and also to make sure that they're not overspending. And it's also quite a good motivational tool, so it will help each individual department to set targets. So you might have a budget that's set for a target for your sales team for how much you want to achieve in terms of income, which is going to help the people working in that team to give them something to work towards, to motivate them for a target for them to achieve. And it's also could potentially expenditure budgets could help to for the people in that department to motivate them to keeping to expenditure targets, so for not overspending. And also it provides a good measure of performance. So for managers, it can kind of provide a yardstick to judge them against. Have they performed within the budget that they've been set? So there's a few different ways or methods of setting budgets, and we're just going to look at a couple here. So historical budgets are when a business sets budgets based on what's happened in previous years. So this would seem like quite a sensible and logical approach. It doesn't take too much time. You can just have a look at what the budget was for last year, for example, and say, okay, that was set at £500, so maybe this next year you could set it at a similar level, or maybe give a small incremental increase based on that. The problem with that, I would say, is that just because it's last year's budget, what's to say that the next year's budget should be the same or similar? And also you might find that towards the end of the year you've got departments that are kind of using up budgets even though they don't really need them. So if you've got your budget set as £500 and you've only spent £250 throughout the year, then you might find that extra £250 just being used worthlessly because you don't want to then get that taken away the next year. So that wouldn't seem particularly efficient. And so to try and avoid that and kind of tighten up expenditures, you might go for a zero budgeting approach. And that's where you set the budget at zero. It doesn't then mean that you don't spend anything, but each expenditure that you make, you then have to justify that with management and say exactly why you want to make that expenditure, and each one has to be signed off. So that's going to be a really good way to control costs, because every spending decision is going to be really looked at in detail and decided whether or not it's a good idea. But the other side to that is that it's quite a laborious process, going to be quite time intensive. You've got to justify every single expenditure you do. Is that a really good use of management time to be looking at every expenditure, or should you just trust departments to make their own decisions? Now, once you've drawn up your budget and then been through the period that the budget actually covers, you might want to look back and do a bit of analysis on what you actually had in terms of your income and what you actually had in terms of your expenditure and profit. So you might see a table or a situation looking a little bit like this. So you've got your income, your expenditure and your profit. And first of all, you'd have your budgeted figures. So that's your estimate for your income, your target, your estimate for your expenditure and your estimate for your profit. But it's not necessarily going to be the case that in terms of how it actually played out, that's going to be exactly what you received or exactly what you spent. So you'd have your actual figures next in the next column in your table here. And then you do something that we call variance analysis. And that's really simply just calculating the difference between your budgeted figures and your actual figures. So for income here, we budgeted £45,000. We actually spent £55,000, and so our budget variance there would be the difference between the two would be £10,000. For expenditure, we budgeted £30,000, we actually spent £35,000, our variance is £5,000. And then the profit is going to be income minus expenditure, so we budgeted for £15,000 profit, we actually made £20,000 profit, and so our variance there is £5,000. Now you might notice quite a critical part missing here, where I've got an F or an A after each of those variance figures, and those letters stand for favourable or adverse. And so once you've calculated your variance, you need to look back and say, okay, is that better than we expected, or is that worse than we expected? And if it's better than expected, then we call it a favourable variance. If it's worse than what you expected, we call it an adverse variance. But the kind of subtle thing you've got to look out for here is that whether it's favourable or adverse is going to be different depending on whether it's an income or profit budget against an expenditure budget. So if your actual income or profit is higher than what you budgeted for, then that would show a favourable variance because you've got more income than you expected. So that's a good thing. You've got more income than what you were planning for is good, so that's favourable. And that's the same with your profit budget. If you've got more profit than what you expected, if your actual is higher than your budgeted, then you've got yourself a favourable variance. Whereas that's going to be flipped on its head for the expenditure budget, because if you ended up spending more than you anticipated, then that would be an adverse variance. So you can see here we budgeted for £30,000 and we ended up spending £35,000, and so that's a £5,000 variance, and this time it's adverse because we've spent more than we expected. And then the same is the case so with the adverse variance. If our actual income or profit is lower than we budgeted, that will be adverse. As we've just seen, if our actual expenditure is higher than budget, then that will be an adverse variance. So at the start of this video, we mentioned why budgets are good, why budgets are quite useful, but it's really good as well to have some counter arguments, some limitations of budgeting to weigh these against in your evaluation. So I'd say a big thing is that budgets can be extremely heavily affected by external factors which are completely outside of the control of the people that are setting the budgets and the business generally. So you might have a huge economic recession which is going to have a significant impact on your income budget. You might have a new competitor that comes into the market and means that your sales are much lower than expected. You might have a change in raw materials costs, which means that your expenditure is significantly higher than expected. So you've got to be really flexible and be able to respond to those situations and not just stay really rigidly to the budget that's initially been set. And so based on that as well, you need to have an awareness that for these limitations of budgeting, and then so not spend all of your time and resources preparing the most carefully and perfectly planned budget, because as with anything in business really, you want to consider what we call the opportunity cost of that process. So what have you had to give up in order to create your budget? And if you've had to give up all sorts of other beneficial things that you could be doing for your business, then actually maybe you should spend a bit less time budgeting and a bit more time focusing on some of those other things. But, and I think this is quite an obvious statement, I think even with some of these limitations, it's a really, really useful and sensible process, and it means that, you know, most, if not all businesses are going to carry out that process of budgeting to be able to monitor their performance, set targets, motivate their staff, and give something that management can look back on and see whether they've kind of achieved their aims for income, expenditure and profit.